and I'm focused exclusively on global value investing. So most people, when I come speak to them, want to know a little bit about my very famous great uncle, Sir John Templeton, who pioneered global value investing. Now, I know that a lot of you are younger and may not be very familiar with his career, so I thought we would hit some of the highlights. So Uncle John was born in 1912 in a tiny town in Tennessee called Winchester, Tennessee. It's where I grew up and it's where my parents still live to this day. He was the youngest of two sons, and he left Winchester, Tennessee to attend Yale University. It was during the Great Depression. And during his time at Yale University, he received a letter from his father, my great-grandfather, saying that he could no longer afford college tuition, even to the tune of $1 more. Uncle John often remarked to me that that was one of the best things that ever happened to him in his entire life. Instead, he went out and got several jobs and also started playing poker. And he was a very good student of probability. But he graduated from Yale University in 1934 at the top of his class. He was president of Phi Beta Kappa, which is the oldest and most well-known honor society in the United States. He was the recipient of the Rhodes Scholarship, and he went and attended Balliol College at Oxford, where he graduated with a degree in law in 1936. He left Oxford on a trip around the world with a friend. They visited 27 countries, and it was a trip that shaped his viewpoint for many years to come. He ended up at the 1936 Olympics in Berlin, where he saw the building contingency of Nazi soldiers. He was known as pioneering value investing and international investing. Money magazine named him arguably the greatest stock picker of the 20th century. Before he died, he gave most of his wealth to some foundations, the Templeton Foundations, which fund the world's largest cash prize. So the Templeton Foundation gives out the Templeton Prize once a year, and it always exceeds the Nobel Prize because he was, after all, an intensely competitive person. And he wanted it to always be the world's largest cash prize. Lots of interesting people have won the Templeton Prize, and it's given out for progress in spirituality and religion. Now, I like to start all of my presentations with a few of his quotes, just to familiarize yourself with his investment strategy if you're not already familiar. The first is, a major cause of higher prices is higher prices. But when the trend is reversed, then lower prices lead to still lower prices. To buy when others are despondently selling and to sell when others are avidly buying requires the greatest fortitude and pays the greatest ultimate rewards. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. An investor who has all the answers doesn't even understand the questions. If you want to have better performance than the crowd, you must do things differently from the crowd. And lastly, people are always asking me where the outlook is good. That is the wrong question. The right question is, where is the outlook most miserable? So, my uncle always had a desk plate in his office that simply read, "Trouble is opportunity." And we have had those replicated and have them in my office as well. It's a really good reminder of his investment philosophy. But today, I want you to all be global trouble hunters with me. And we are going to look at some historical points of trouble, and then also some trouble that might be brewing in the future. So this requires some imagination. I want you to imagine that you've worked really hard your entire life. You've been a saver, you've done all the right things, made those decisions, the hard decisions You've invested your capital in the market. This is the stock market crash of the Great Depression, where investors lost 87% in 3 years. This stock market crash almost took out the father of value investing, Benjamin Graham. Both Sir John and Warren Buffett are well-known students of Benjamin Graham, but it almost demolished even the father of value investing. Here's a graph of the 1970s bear market. This decline is only 48%. Would you be a buyer at the bottom? If you think so, remember that this stock market crash occurred with runaway inflation, skyrocketing unemployment, oil embargoes, gas shortages, and rationing. What would have been your perspective at the bottom of this market? Would you be buying stocks, or would you be hiding under your desk? This next graph is a graph of Black Monday, which occurred in 1987. This is a well-known crash in the market. The Dow Jones lost 22% in one day. Now, I actually remember this crash. My dad was a stockbroker at Dean Witter Reynolds, and I remember being in the living room at home with my mother. My dad came home from work and he asked her to step outside in the hall, and he closed the door. And I imagine that he told her that they had lost probably 25% of their net worth that day. It was not a sad day in our home, though. I just remember him doing that. Uncle John was well known on this day for saying, "This is going to make our returns for years to come." He was a buyer that day. Now, my husband did a recent revision of the book, The Templeton Touch. And when he was writing that book, we went and interviewed a lot of famous money managers that knew my uncle. And we interviewed one of his old employees named Marty Flanagan. Marty is now the CEO of Invesco. But Marty said, on the day of the crash in 1987, Uncle John got up, left the office to go walk in the surf for an hour. He did that every single day. A lot of value investors, as you know, Saurabh, have this built into their daily schedule, whether it's Monish's nap room or some type of physical activity. But he got up like it was no other day, and he left and he went and walked in the surf. And when he came back to the office, he was greeted by a bunch of young analysts who said, Sir John, don't you see what the market has done? How could you have left the office? And he said, boys, sit down. I have good news and bad news. The bad news is we're in a bear market. The good news is it's almost over. Now, we've also interviewed a broker that had an open line to his office that day, and that broker tracked all the purchases in a ledger and calculated the return 2 years later, and Uncle John had made 200% of those investments that day. Now, if you had just held on to your investments, the Dow was back up to where it was before the crash 2 years later. If you had invested in an index tracking the Dow at the bottom, you would have had a 60% return off the bottom. So just something to remember during these events. This is the dot-com bubble crash, where the market lost 50%. This is the S&P 500. The NASDAQ lost almost 80% during this crash. I also remember this one well, as I was working as a sales assistant at Morgan Stanley to two technical analysts. It's kind of the antithesis of all things Templeton. But I was there, and the wealth effect was in full view. I mean, there were steak dinners and champagne nights, and there was a new IPO every day. People were so excited. And I made the regrettable error of going down to the Lyford Key Club and meeting with my uncle and asking him, what tech stocks are you buying? And he just shook his head at me and he said, you know, Lauren, when I was a child, I would walk from my house in Winchester, Tennessee to the town square, and my brother would go with me. And we would gather in the yard of a home, and lots of people would gather. And eventually the owner would come out and flip a switch and lights would come on and light up the house. And that was the spread of electricity. He said, now I went back and calculated it, and the time to get out of those stocks was 2 years prior to that. And then he walked me through every bubble he had seen in his lifetime. shorting tech stocks, which took, a lot of courage during that market. But he was using a strategy referred to as the IPO lockup strategy. So he knew that even the insiders of these companies knew their companies were overvalued, and that they would take the first chance they got to sell the shares. So he would short stock 7 days prior to the IPO lockup expiration and cover about 10 days later. I never asked him how much money he had on during that trade, but we've heard he had $400 million in short positions, and that he made over 90% on many or most of those trades. So that was a really interesting time. And then of course you all remember the most recent financial crisis, where we had almost a 57% market correction. Now that was a great day for me. Actually was pregnant with my firstborn child during that, and she was born on March 10th, 2009. The market lows were on March 9th, 2009. So I remember vividly buying stocks in the delivery room, and the nurse came in and told my husband to shut down the computer. And I looked at him and said, "Did you get the orders filled?" Because we had been buying stocks for months prior to that event, and we knew that the markets were being really irrational with valuations, and we wanted to buy as much as we could. Now, market corrections and crashes are a staple to the market. They're going to happen. It's not if, it's when. So since 1900, there have been 125 corrections. Corrections are defined as a drawdown of 10% or more peak to trough. There have been 32 bear markets defined as a 20% drawdown or more peak to trough. So you're going to spend about 1/3 of your life in bear markets. Bear markets come along every 3.5 years. Corrections come along every year. Really good investors have learned to harness the power of the bear market to boost their returns for years to come. That's really what distinguishes an average investor from a great investor.